A fund that absolutely smashes the index. There's not many of them. It is like finding a needle in a haystack, but when you do find one, it's well worth researching it further. So in this graph, we've got the active fund versus the sector that it's in, and over 1, 3 and 5 years it's been in the top quartile of that sector. It's had some very consistent outperformance, so that outperformance has not just been 4 or 5 years ago, it's pretty much been across the whole time frame. So when you see one of these, you've really struck gold. So stick with this video and I'll explain all about it. So which benchmark should I try to outperform? Well, possibly just a global tracker, possibly the S&P 500. What time frame to use? I think 5 years is ideal. You've got a mix of pre-COVID, the 2021 growth and the 2022 value. So the disadvantages of the S&P 500 are really that the things that will make it go up a lot are also the things that will make it come crashing back down. So that's things like the strength or weakness of the dollar, what's happening with US interest rates, whether there's any recession that's a bit more US centric rather than the rest of the world, the PE multiple that most American companies seem to be trading on, whether that's rising or not, whether technology seems to be popular amongst investors. So all these factors can either work in your favor or against you. So you have to be a bit wary of that. And now I'm maybe thinking that perhaps S&P, but with maybe the Euro Stoxx 50 might be a better way if you don't want the whole of the developed world, and particularly Japan that I'm not so keen on. So mean reversion, this is more common than you might think. That you get a fund, it does really well, you maybe add to it or start to buy it, but eventually it just all comes crashing back down again, as is what happened to Scottish Mortgage, and it's got more of this underlying growth rate of maybe 6-7% a year, or maybe more, but when it exceeds that by a wide margin, it's just not sustainable, and the only way to bank that growth would be for it to like sell most of its portfolio and completely refocus the fund, but it never does that. So that you've got various types of equity funds. You've got growth that can vary from the sort of Bailey Gifford pre-revenue to growth at a reasonable price, which is more like your kind of fund smiths. You've got value, which could be a low PE ratio, so at least it is profitable, or you've got like a price to book ratio, so you've got a lot of assets that you're buying every time you buy a share. Maybe you're paying less than the net asset value for the company, but these companies might be unprofitable. For income, you can have high yield, or you can have maybe ones that pay a growing dividend, but the dividend isn't high enough and you can't live off the proceeds. So the danger is you could get the growth company that never makes a profit, the recovery stock that never recovers, and the yield trap that just collapses under its own debts. So what you could do if your income fund doesn't pay you enough in dividends is you can just sell down your stake. So imagine that you invest in McDonald's or Starbucks, something like that. It's got 1,000 outlets. You own 0.1% of their company, so you own the equivalent of one outlet. 10 years later, it's double the number of outlets to 2,000. You've sold down your stake to 0.05%. So now, what have you got? Have you got the same purchasing power in terms of your investment? Well, I'd argue that you have. You've got the equivalent of one outlet. And I think the key thing is the quality of the business. You could have invested in Woolworths as a value play, and then what would you have? Like 1% of nothing. So I think there's a dividend sweet spot. And there's a reason why it's Amazon Web Services and not Vodafone Web Services. And it's because, well, Vodafone doesn't really innovate, and it's kind of collapsing into itself under the weight of the dividend burden and the debt burden. But then also, if you're investing too much, then you can end up just chasing poor quality projects, and that can really lead to problems as well, because that's called like diversification. So the balance, I feel, is paying about a 2 to 3% dividend yield whilst maintaining the capital competitive advantage of your business, and then controlled expansion into new areas that are kind of tangential to what you're already doing. So I've got selection criteria for a fund here. And you're probably better off just pausing the video and reading it yourself. But the key thing here is that I want something that doesn't deviate too much from a global tracker. I want it to be more of a best of rather than something that's just completely different. So if I wanted to come up with something that's better than the Beatles' White Album, you could say, oh, well, this Oasis is better, but it's just different. I might take the White Album, get the best songs on it, and ignore the dross, and then you've got something that sort of is a bit more cohesive and is a bit more of a better thing. And I'm looking at performance of the fund, I'm looking at price growth and volatility, so I'm looking at the Sharpe ratio, and that's quite important. I'm looking for something with not too excessive fees and not too much concentration in the top 10 holdings. I'm looking for something where the fund size is pretty reasonable, because anything that's decent, if it's open-ended, then it will attract investors and it will grow in size. So one website you can use is Fund Caliber, and this is looking at global equity income, which is the sector that I'm looking at for outperformance. And it's got these selections. They're all pretty good, maybe apart from Murray International Trust. The reason there is that it's currently, I think, on a premium to net assets, but it has gone at a discount of maybe up to 10% at times. So if you're buying that now, you do risk this price to net asset value cycle moving against you. So at the moment, I would probably look for the open-ended funds. So how do you like them apples? Well, this is the one I've selected, JP Morgan Global Equity Income, and it beats its sector quite convincingly. So it's got 77 holdings, ongoing charges fee 0.9%, little bit on the high side, size 380 million. I'd have thought it would have been bigger given what it's done. Top 10 holdings, yeah, I mean, I like Microsoft. Some of the holdings I've never really heard of, but that's kind of a good thing, because you want it to buy things before everyone's talking about it. You don't want it to have Alibaba when people have been banging on about that for years. So asset class breakdown, it's fairly similar in geographic split to a global fund, so that's good. Sector breakdown, banks at number 1. When I scripted this, it was before the Silicon Valley collapse, so I was going to say, oh, that's good, banks are doing well at the moment. So yeah, how things can change, but it's a reasonable spread there in terms of the sectors. So how does it compare to the last video? I'll put a link to it here, where I looked at the Wisdom Tree Global Quality Growth Dividend, and it does beat that fund, and it also beats a global tracker as well. And then the performance is fairly consistent, that it's pretty sort of slow and steady, and it's getting there, whereas the global tracker has gone sideways for a year. So you've got the tortoise that beats the hare, and it goes from being the worst here to being, well, pretty much first. So the problem is you've got, I'm a great stock picker, look, I'm number 1, I'm outperforming, life is great, give me all your money, to suddenly, oops, oh, market conditions are unfavourable to my fund. And you have to wonder whether this is more beta and it's more a concentrated fund, doesn't have many positions, and if they're in favour, then it will outperform just from the nature of what it's doing, and then that will just all unwind. And then the picture against global investment trusts is again similar, and we've got the best performer, which was Martin Currie here, then moving to being the worst performer. So you've got a lot of volatility, and you've got to really hold your nerve to stick with it and to wonder, well, you know, what the hell is going on and what should I do? Whereas, you know, the JP Morgan Global Equity Income, just a nice slow and steady path. And I do find most global investment trusts they're just a bit disappointing, and people will say, well, I've held foreign cannoli oil for 20 years and I've made this much money on it, and that is true, but they don't say, if I'd invested in a global tracker, and unfortunately they weren't around 20 years ago, you probably would have made more money, you would have had less of a drag from fees, and you wouldn't have to worry about the fund manager and what are they doing, are they actually making the right selections on your behalf. So JP Morgan Income is very similar to the investment trust that I like, JP Morgan Global Growth and Income, JGGI. Sometimes it's neck and neck, but it does actually slightly come out ahead. So with JGGI, it is different management. It is a slightly different holdings of companies, but it's a similar methodology that they just get all the research reports that JP Morgan produce and just pick the ones that they like and slot those into the fund. So they're not that wedded to some of the selections in the fund because they didn't do all the research themselves, and they don't become too obsessed with what they're researching. They're just getting other people's data and applying it. So finally, I hope you enjoyed the video. Check out this one. I think it's going to be really good. I think you really like it. And do your research. Don't be a Vanguard Muppet.